You mark the last opposing candle. Clean formation, clean displacement following it. The structure matched everything the concept required. You placed your entry at the order block, your stop just beyond it, and waited for the reaction. Price entered the zone and kept going. Straight through your order block, through your stop, through the entire candle you had identified as institutional activity. And then, from somewhere below the level you were certain about, the real move began. You were not wrong about the concept. You were wrong about what the concept was actually telling you to find. Because an order block is not the last opposing candle. It is the exact movement one side of the auction ran out of the ability to contain the other and left behind the evidence of dead failure in the candle tried hardest and lost. By the end of this video, you will understand what an order block actually is institutionally, not as a candle pattern, but as a visible footprint of an execution problem being solved. You will understand why the displacement that follows the order block is more important than the candle itself, because the candle is the origin and the displacement is the proof. And you will understand the precise mechanical difference between an order block, a fair value gap, and a supply and demand zone. Three concepts most traders treat as separate systems that are actually three different lenses on the exact same institutional event. And you will understand when an order block stops being valid, because the traders who hold positions against dead order blocks are not reading the market wrong. They are reading a historical record and mistaking it for a live signal. Stay with me. I am Bilal, the disciplined trader. Here is the specific experience most traders have with order blocks. They learn the concept, the last bearish candle before a bullish move, the last bullish candle before a bearish move. They learn to mark the origin candle, draw the zone, and wait for price to return. The concepts makes intuitive sense. The examples in the educational content all work. Confidence builds. Then the live market produces the setup and the inconsistency begins. Some order blocks produce violent rejection. Price touches the zone and immediately displays back in the original direction. Others produce partial reaction before continuing through. Others get consumed completely. Price accept through the entire candle zone without producing any meaningful response. And some order blocks sit on the chart for sessions, perfectly valid by every visual criterion, never producing a reaction worth trading. The trader cannot find the pattern that separates ones that work for the ones that fail. They add refinement. Only trade order blocks at higher time frames. Only trade order blocks after liquidity sweep. Only trade order blocks with fair value gaps nearby. Results improve slightly. Then the same inconsistency returns in a new form, because the fundamental problem was never the refinement. The problem was the definition. They learned which candle to mark without learning what that candle matters. They learned the visual signature without learning the institutional problem. The candle was the solution to, and a candle without the institutional problem it solved is not an order block. It is just a candle. And the market has no obligation to react to candles. It only responds to unresolved execution conditions. The visual appearance of an order block and the institutional significance of an order block are two completely different things. The traders who consistently succeed with this concept are not the ones who mark candles more precisely. They are the ones who understand what those candles represent mechanically and why only specific candles in a specific context represent anything at all. Here is what most traders believe about order blocks. They believe the candle is the important thing, that identifying the last opposing candle before a significant move is the skill, that institutional participation is somehow embedded in that specific candle and price must return to interact with it, because institutions left unfinished orders. They are waiting to be filled again. That belief is mechanically incomplete to the point of being dangerous, because institutions are not placing pending orders at specific candles and waiting for price to return. Execution is not frozen in historical candles. The market is a continuous adaptive auction, and the conditions that made a specific location significant in the past may or may not still exist when price eventually returns. Here is the contradiction that changes everything. Traders believe the candle is the order block. Operator understand the candle is the evidence and the execution problem it solved is the order block. Read that distinction carefully. An order block is not a candle pattern. It is the price region where large institutional inventory was accumulated, distributed, absorbed or transferred before an aggressive repricing event occurred. The candle marks the final area of efficient execution before imbalance overwhelmed the auction. The candle matters not because of how it looks, but because of what was happening inside the auction during its formation. You were not looking for the last opposing candle. You were looking for the exact movement one side of the auction ran out of the ability to contain the order and left behind the evidence of that failure in the candle that tried hardest and lost. That is what an order block actually is. The candle that tried hardest to prevent the displacement and failed because that failure is the evidence that inventory transfer completed, that opposing liquidity was exhausted, that the imbalance became so extreme that the auction could no longer remain balanced and aggressive repricing become inevitable. The candle is not the story. The failure is the story. And the displacement that followed is the proof that the failure was real. In a moment, I am going to walk you through the three-phase sequence that creates every valid order block: liquidity access, absorption, and the threshold break that produces displacement. But before the sequence, you need to understand why the displacement is more important than the candle, because most traders start with the candle and work backward to displacement. Operators start with the displacement and work backward to the origin, and that reversal of direction from consequence to cause rather than from cause to consequence is the perceptual shift that changes everything about how you read a chart. The three-phase sequence. Every valid order block is created by the same three-phase institutional sequence. Phase 1. Liquidity access. Before an institution can build a large position efficiently, it needs counterparties. Sellers if it wants to accumulate longs, buyers if it wants to distribute shorts, and the most reliable place to find concentrated opposing participation is exactly where human behavior predictably clusters, at obvious highs and lows, at equal structure boundaries, at the levels every trader independently notices and independently places orders around. So price moves towards those concentrations. Equal lows swept, stop cluster triggered, breakout traders trapped, panic sellers activated, the concentrated sell side float that large buy side participant needed before they could execute efficiently, created by predictable human behavior at predictable locations. The liquidity access phase prerequisite. Without it, the absorption that follows lacks the counterparties that make efficient inventory transfer possible. Phase 2. Absorption. This is the hidden phase, the one retail traders almost never see correctly. Inside the future order block, while price appears to be moving in one direction with candles that look bearish, with momentum that feels like continuation, the opposing inventory transfer is occurring beneath the surface. Sellers are entering because the chart looks bearish. Breakout shorts are building positions. Retail traders are confident in the direction, and simultaneously, large buy-side participants are observing every sell order that enters the market, not aggressively, not visibly, quietly consuming the available opposing flow without allowing price to reprice efficiently in the bearish direction. You have been in this situation from the retail side. You have been inside the absorption phase without knowing it had a name. The candle that looked like continuation, the bearish move that felt like confirmation, the short position you took with confidence right at the moment the absorption was completing beneath the surface, and then the violent reversal, not a gradual turn, an immediate committed displacement in the opposite direction that left you no time to react. In that movement, sitting in front of a screen, watching your position move against you, the feeling was specific, not just financial pressure, a kind of confusion that went deeper than the loss itself. Because the candle had looked right, the direction had felt certain. Nothing in what you were thought prepared you for a move that looked exactly like confirmation and produced exactly the opposite result. That confusion was not a reading failure, it was the absorption phase completing, and your participation in it was exactly what the sequence required. That feeling of certainty right before a violent reversal is not coincidence. It is the absorption phase reaching its conclusion. The trapped participants whose forced exit are about to become the fuel for the displacement phase 3. the threshold break. Eventually, the available opposing liquidity becomes exhausted. Sellers have been absorbed. The remaining sell side flow is inefficient to contain the buy side pressure that has been building underneath the surface. Balance cannot hold, and then aggressive repricing begins. The displacement that validates everything that preceded it, large bodies, aggressive closes, minimal overlap, fair value gaps appearing inside the move as price skips through level without negotiation, structure boundaries broken, trapped participants whose forced exist accelerate the continuation. That displacement is not just the move, it is the proof. Without a strong displacement, there is weak evidence that meaningful inventory transfer occurred in the preceding candle. Without the displacement proving that the threshold broke, that absorption completed, that imbalance overwhelmed the auction. The origin candle is just a candle. The displacement validates the order block, not the other way around. This is why operators start with the displacement and work backward to the origin, because the displacement tells you whether something real happened and the origin candles tells you where it happened. Valid order blocks versus noise. Three conditions separates a valid order block from a candle drawn over a random pause in price. First, displacement quality. The move away from the original must communicate urgency. Large candle bodies, aggressive directional closes, minimal overlap with what preceded the move, fair value gaps appearing inside the displacement as evidence that price moved too fast for balanced two-way trade. Structural consequence: a broken swing, a changed order flow, a delivery state that visibly shifted, weak displacement, slow drift, overlapping candles, immediate retracement. No structure effect communicates fluctuation, not institutional aggression. The threshold did not break. Absorption did not complete. The origin candle is not an order block. It is a candle that happened before a minor move that could have been anything. Second, liquidity context. Valid order blocks almost always form after a liquidity event. A sweep of obvious structural boundaries, stop cluster triggered, emotional participation activated, the concentrated opposing flow that institutional execution required before absorption could occur. An order block forming in the middle of a balanced range without preceding liquidity interaction carries weak institutional logic. Large participants need counterparties. Without a liquidity event providing those counterparties, the absorption that creates the order block lacks the opposing flow that makes institutional scale execution possible. The presence of a preceding liquidity event is not confirmation that the order block is valid, but the absence of one significantly weakens the case that meaningful inventory transfer occurred at the origin candle. Third, control transfer. This is the deepest filter and the one that requires the largest perceptual shift. A bullish order block is not identified by finding the last bearish candle. It is identified by finding the candle where sellers ran out of the ability to contain buyers. The candle that represented maximum sell side effort and produced the exhaustion that followed buyer dominance to emerge. A bearish order block is not identified by finding the last bullish candle. It is identified by finding the candle where buyers ran out of the ability to contain sellers, the candle that represented maximum buy side effort and produced the exhaustion that allowed seller dominance to emerge. The candle often looks deceptive. A bullish order block frequently contains bearish looking candles because the sellers were still trying. A bearish order block frequently contains bullish looking candles because the buyers were still fighting. This is not contradiction. This is institutional logic. The losing side provides the liquidity. The winning side needs the maximum effort of the losing side. The final aggressive attempt to prevent the control shift is precisely what makes the order block candle institutionally significant. Identify order blocks not by candle color. Identify them by which side lost control. The unified picture. Now the concept that completes the phase 2 understanding and connects everything you have learned in this series. Order blocks, fair value gaps and supply demand zones are not three separate concepts. They are three different lenses on the same institutional event. When aggressive displacement occurs after a liquidity sweep and absorption, when the threshold breaks and the auction precisely urgently, three simultaneously footprints appear on the chart. The order block is the execution origin, the final efficient execution zone before the imbalance overwhelmed the auction, the candle that marks where inventory transfer occurred, where the losing side made its final effort and failed, where control shifted from one side to the other. The fair value gap is the delivery imbalance, the inefficiency left behind during the displacement, the levels that price passed through without negotiating, where the market moved too aggressively for balance two-way trade to develop, the evidence that urgency replaced efficiency during the repricing event. This supply and demand zone is the broader reaction territory, the entire region where aggressive imbalance overwhelmed the opposing side, the macro view of the same event, less precise mechanically than the order block, less specific structurally than the fair value gap, but broader in its representation of where institutional pressure dominated. Same displacement event, three different mechanical focuses. The order block asks where did execution occur. The fair value gaps asks where did delivery become inefficient. The supply and demand zone asks where did aggressive imbalance overwhelm the auction. This is why marking all three from the same displacement and calling it triple confluence is a mistake. You are not finding three independent information. You are looking at one event through three lenses and counting it three times. The operator who understands this stop staking concepts and start reading the event. One displacement, one institutional problem solved, three ways to describe different mechanics of the same solution. Now I want to show you this complete sequence on a chart and then the specific behavioral difference between an order block being tested and an order block being invalidated, because that distinction between a zone that is being mitigated and a zone that is already dead is where most traders who understand this concept make their final and most expensive mistake. Picture this on a chart: bearish trend, clear lower highs and lower lows. Then price sweeps below the most recent swing low. Stops trigger, panic seller enter, breakout shorts pile in, the concentrated sell side flow that large buy side participants needed deposited at the predictable location by predictable human behavior. Now watch the candles that form immediately after the sweep. One or two bearish candles, the sellers are still pushing. They see the sweep as confirmation of bearish continuation. They are adding to short position. They are confident. The chart still looks bearish, but inside that final bearish candle, absorption is occurring. The sell pressure that retail is providing is being consumed without allowing meaningful downside continuation. Something is holding the market up while it looks like it should be going down. That final bearish candle, the one that tried hardest to continue the downward move and produced no meaningful follow through, is the order block. Then displacement, a single bullish candle with urgency that the preceding bearish candles did not have. Large body, aggressive close. The candle after it continues immediately, a fair value gap appears inside the move. Price skipping through levels without negotiation. The previous high breaks, structural consequence is immediate and visible. The displacement is the proof, the order block is in the origin. The fair value gap is the inefficiency left behind. All three emerged from the same event. The movement, seller control exhausted, and buyer dominance emerged. Now price advances. Session pass, the order block sits below current price. The final bearish candle before the displacement carrying the unresolved execution conditions of its origin. Then price begins retracing. The retracement is controlled, measured, price descending back toward the origin candle. And now inside the retracement, the auction is conducting its test. It is the imbalance still defended. Does the campaign still have sponsorship? Is the control that shifted at the origin candle still active? Price enter the upper edge of the order block candle. The candles entering the zone begin slowing. Bodies shrink. Wicks appear on the downside as the price attempts to continue lower and fails. Something is absorbing the pressure. The same character of absorption that preceded the original displacement. Then a bullish displacement candle with the same urgency as the original move continuation follows. The campaign resumes. The test is complete. The imbalance was still defended. The control shift was still active. The order block produced the reaction its institutional significance promised. Now picture the same chart, same visual formation, but this time the displacement was weak. Slow candles, overlapping structure, no liquidity sweep before the move, No structure consequence. The origin candle was marked as an order block, but no meaningful execution problem was solved there. Price returns to the zone and accept through it. Candles from inside the original candle zone comfortably. Rotation develops. The market facilitates trade at prices the original move barely touched. No urgency, no rejection, no defended imbalance. The order block is consumed because there was no institutional execution problem behind it, just a candle that came before a move, and the market has no obligation to react to candles. Invalidation. Most traders who understand order blocks still lose money at them, not because they cannot identify valid zones, but because they cannot accept when a valid zone is no longer valid. The zone becomes part of their identity. The trade becomes a belief, and invalidation the zone means admitting the campaign changed, which feels in that movement like admitting something larger about the analysis. And order block does not become invalid emotionally, it becomes invalid mechanically. Four behavioral signals that communicate an order block is losing or has lost its institutional significance. First, acceptance through the zone, not a week beyond it, not a brief penetration followed by rejection. Acceptance, candle bodies forming beyond the order block zone, the market facilitating comfortable trade at prices the original order block was supposed to defend, the auction normalizing at those levels rather than rejecting them. When the market accepts through an order block, the imbalance that gave the zone significance has been resolved. The execution conditions that made it institutionally relevant no longer exist. The zone is a historical record, not a live signal. Second, opposite side displacement. A bullish order block that produces bearish displacement through it is not being tested, it is being overridden. The campaign changed direction. The control that shifted bullish at the origin candle has been recaptured by the bearish side. The original institutional significance is gone. Third, weakening reactions on repeated visits. Fresh order blocks react strongly because the imbalance is unresolved and the execution conditions are still active. Every subsequent visit consumes same of the liquidity and resolves some of the imbalance. By the third or fourth visit, the zone that produced violent displacement initially may produce almost nothing. The edge decays with each interaction. Freshness matters. Fourth, structural failure. The order block that originally caused a break of a structure loses significance where that structural consequence is reversed. Structure reveals campaign health. If the campaign built on the order blocks, displacement is failing structurally, the order block itself is losing its institutional foundation. The operator who recognizes these signals early exits the position, removes the zone from the chart, and moves attention to the next meaningful imbalance. The operator who ignores these signals, who defends a dead zone with capital they cannot afford to lose, becomes the liquidity that funds the move through it. Testing is not invalidation, acceptance is. Learn the difference before the market teaches it with your account. You are not looking for the last opposing candle. You were looking for the exact movement one side of the auction ran out of the ability to contain the other and left behind the evidence of dead failure in the candle that tried hardest and lost. The candle is not the order block. The failure is the order block, and the displacement is the proof that the failure was real. When you mark a candle without the displacement that validates it, you were marking a historical record and calling it a live signal. When you mark a candle without the liquidity context that makes institutional execution possible, you are marking a visual pattern and calling it institutional activity. When you hold a position at a zone that is being accepted through that the market is normalizing at rather than rejecting, you are defending a story that the auction already resolved. The order block was never about the candle, it was always about the execution problem. The candle solved, and the only question that matters when price returns to the candle is whether the problem is still unresolved. The shift this concept creates happen at a specific moment in your development, not when you learn to filter order blocks by displacement quality or liquidity context. Those are improvements to the same candle hunting framework you already had. The shift happens when you look at a displacement candle after a strong move. And instead of asking which candle came before it, you ask what execution problem that candle was the solution to. What institutional problem required that specific location for inventory transfer, what opposing liquidity was available there, what absorption occurred inside the candle that the visual appearance concealed. When those questions replace the search for the last opposing candle, the chart changes. You stop marking everything that looks like an order block. You start studying the events that produce order blocks worth watching, the liquidity access that created counterparties, the absorption that consumed opposing flow, the threshold break that proved the imbalance was real. And when price returns to a zone, you stop asking whether it will react. You start asking whether the execution conditions that made this location meaningful are still present, whether the imbalance is still defended, whether the campaign built on this origin is still running. The order block stops being a trade, it becomes a test. And every time price returns, the market is running, that test is real time. The operator reads the result. The retail trader already has a position before the test begins. Three mistakes that prevent this from being installed. Mistake 1. Hunting candles instead of execution problem. The trader learned the definition last opposing candle before a significant move. They open their charts and search for candles that match the visual description. They find them, many of them, and they mark them all. But the visual appearance of an order block and the institutional significance of an order block are two completely different things. A candle that came before a move is a candle. A candle that marks the exact movement one side exhausted its ability to contain the order other after a liquidity event through absorption proven by genuine displacement is an execution problem with unresolved institutional conditions behind it. The market only responds to the second kind. Hunters find candles, operators find execution failures. Those are not the same search. Mistake 2. Counting one event 3 times. Price sweeps a low, displaces aggressively upward, and breaks a structure. The candle marks the order block. They also mark the fair value gap inside the displacement. They also draw a demand zone over the origin area. 3 zones, 3 confirmation, high probability setup, but all 3 emerge from the same displacement event. The order block is where execution occurred. The fair value gap is where delivery become inefficient. The demand zone is the broader region where imbalance overwhelmed opposing liquidity. Same event, 3 lenses, 1 source. Treating them as independent confirmation triples the perceived confidence without adding any new evidence. The position size that follows from that false confidence taken on an account where every stop matters is the compounding error. Read the event once, read it deeply. Do not count it 3 times and call it edge. Mistake 3. Holding against the invalidation signals. The order block was valid, the entry was placed, but now price is returning to the zone and something is different. The candles entering the area are overlapping. The market is spending time there. Rejecting is not appearing with the urgency that defined the original displacement. The trader within the stop tells themselves tested not broken, builds a narrative around why the zone must hold, and the market accepts through it. An order block does not fail emotionally. It fails mechanically when the execution conditions that made it significant are no longer present, when acceptance replaces rejection, when the market facilitates trade at prices it previously refused, when the opposing side delivers through the zone with commitment. Those are not signals to hold. They are signals that the analysis was correct and the campaign changed. The operator who reads that change early exits the position, removes the zone, and moves to the next meaningful imbalance. The operator who cannot becomes the liquidity that funds the move through the zone they refused to release. Here is what I want you to do before your next session. Find 5 order blocks on your charts from the past month, the ones you marked and traded with confidence. For each one, do not analyze whether price reacted or consumed at the zone. Do not analyze the entry or the outcome. Analyze the execution problem. Was there a liquidity event before the origin candle? A sweep of obvious level, obvious structure, stop cluster triggered, emotional participation activated, or did the candle appear without preceding liquidity interaction? Was the displacement strong enough to constitute proof? Large bodies, aggressive closes, minimal overlap, structural consequence, or was the move slow overlapping, immediately retraced, and which side lost control at the origin candle? Was the candle the final effort of sellers before buyers gained dominance, or the final effort of buyers before sellers took over? Was control transferred, or was the candle just a candle? 5 zones, 3 questions each. Stop hunting candles, start finding execution failures. The candle is the evidence. The execution problem is the order block. The displacement is the proof. Stop starting with the candle. Start with the displacement. Work backward to the origin. Ask what problem was solved there. And when price returns, ask whether the problem is still resolved. That is the only question that matters. If this is the work you are doing, stay on this channel.